Welcome to the Deep Dive, where we take your stack of sources and distill the absolute essence. Today's mission is all about knowledge optimization. We're giving you the shortcut to being well-informed on two really critical financial metrics.
That's right. Metrics that every investor, and honestly, even anyone interested in organizational efficiency, really needs to understand.
We are diving deep into the expense ratio and the Sharpe ratio.
And these are not just, abstract concepts for Wall Street analysts. If you, the learner, are evaluating a retirement fund, or maybe you're vetting a hedge fund manager, or even just deciding which charity to support.
Right.
These two ratios are the lenses. They help you evaluate both the guaranteed cost of accessing a return and, well, the quality of that return, adjusting for the risk you're taking.
And we're going to spend time on the surprising implications, not just the textbook definition.
Absolutely.
Okay, let's unpack this. We have some excellent source material here defining both of these terms and exploring their implications in mutual funds, hedge funds, and even charity organizations.
It's a wide-ranging topic.
It is. So let's start with the metric that's, well, it's concrete and it's guaranteed because it silently eats away at returns every single year. The expense ratio.
Right, the invisible cost.
The invisible cost of investing.
So the expense ratio, or ER, is actually pretty straightforward in what it represents. It's the total percentage of a fund's assets that gets consumed annually by all the operational costs of just running that fund.
Okay, we're assuming our listener knows the basics, so let's jump right into the nuance. The ER is that total percentage for administrative, management, all those operating expenses. What's the key implication of that percentage hit?
The implication is, it's brutal and direct. If a fund has an ER of, say, 1.2%, then 1.2% of the fund's total assets are just subtracted annually.
Regardless of performance.
Regardless of whether the fund makes money or loses money. It's a structural drag that directly reduces your gross return before you see a single cent of profit.
Now, a common misconception is that the expense ratio represents the entire cost of owning that fund. But that's misleading, isn't it?
Oh, it is absolutely crucial to be clear on what the ER does not include. It doesn't cover sales loads.
Which are the upfront or deferred charges.
Exactly. The sales charges you pay when you buy or sell shares. And it also doesn't cover brokerage commissions. I mean, those are the transaction costs the fund manager racks up when they're buying and selling securities inside the fund.
So those are separate costs borne by the investor.
They are, and they can be substantial, especially for funds that are really actively traded.
So the ER is like the internal engine's operating cost. And that cost isn't just a random number. It's influenced by some pretty clear structural factors. What drives it up or down?
There are two primary factors. First one is fund size. This all comes down to economies of scale.
Okay.
Think about it. A smaller fund has the same mandatory fixed costs as a huge fund, things like annual regulatory audits, legal compliance, even rent for the office. If you have to spread those fixed costs over a small asset base, the resulting ER as a percentage just has to be higher.
So as the fund gets bigger, that percentage should drop.
It should theoretically drop, but as we're going to discuss in a bit, that often doesn't happen as much as you'd think because of how the other fees are structured.
And the second factor has to do with effort.
Yeah.
Management style.
Yes. So passively managed funds, the ones just tracking an index like the S&P 500, they typically have significantly lower expense ratios. We're talking basis points here, like hundredths of a percent. Maybe 0.05% or 0.10%.
Because they're not doing a ton of research.
Right. They require minimal research, fewer decision-making resources. On the flip side, you have actively managed funds. This is where a highly paid team of analysts and portfolio managers is trying to beat the market. That requires enormous overhead and research spending, which drives their ERs way higher, often into the 1.0% to 2.0% range.
Let's focus on a specific and often pretty controversial line item in U.S. funds,
Yeah.
the 12b-1 fee. Our source details the specific caps on this, but instead of just reciting the rule, let's talk about the implication.
The 12b-1 fee is maybe the most fascinating component because it is essentially the fund's marketing and distribution expense, and it's paid for by you, the investor.
My money is paying for the ads.
Your capital is paying to attract other investors. This fee, it's generally capped by FENR at 1.00%, broken down as 0.75% for distribution and 0.25% for shareholder servicing.
That feels really counterintuitive. I'm paying a fee so the fund can grow, which you could argue benefits the fund manager and the company more than it benefits me, the existing shareholder.
And that's precisely the implication. I mean, proponents will argue that growth ultimately benefits shareholders by helping the fund achieve those economies of scale we just mentioned.
Right.
But in practice, it's a direct cost for marketing. For a well-informed investor, if you see a substantial 12b-1 fee, it should raise a flag about where the fund's priorities are. Is it performance or is it expansion?
Now, here's where the analysis moves beyond just the definition and into actual strategy. Unlike trying to predict future stock returns, which is, well, it's notoriously difficult.
A fool's errand, some would say.
Fund expenses are highly predictable.
This is a huge advantage for you as an investor. Funds with historically high expense ratios tend to, continue having high ratios. This is why our source material really stresses examining the financial highlights section in the prospectus. Look at the ER history over the last 5 years. If it hasn't dropped, there's very little reason to believe it suddenly will.
And the question is why? Why is it so hard for a fund that's been around for years to suddenly slash its expenses? Doesn't the massive growth of assets under management, the AUM, inherently make that ratio drop?
That is the critical question. And it all comes down to the mix of fixed and variable costs, because they behave very differently when you measure them as a percentage. It requires some careful differentiation.
Okay, let's try to use that small business analogy you suggested to simplify this, because it can be a conceptual hurdle.
Let's break down the costs. The majority of the biggest operational costs in a mutual fund, like the management fee, that's set as a percentage of AUM. So let's say, for example, the management fee is 0.75%. That 0.75% is fixed on a percentage basis. If the fund doubles in size, the manager's dollar payout doubles, sure, but the percentage taken from your assets stays at 0.75%.
So it's a variable dollar cost, but a fixed percentage cost.
Exactly. And that percentage is sticky. It generally doesn't change unless the AUM hits some pre-agreed breakpoint, which is pretty rare for older funds.
So the biggest piece of the pie, the manager's compensation, is mathematically designed to stay constant as a percentage drag on me, the investor.
Precisely. Now you compare that to the truly fixed costs, the costs that are a fixed lump sum of dollars.
Like rent.
Rent, the annual audit fee, regulatory filing costs. If the fund is small, maybe a $100,000 audit fee consumes 0.25% of AUM. But if that fund grows tenfold, that same $100,000 audit fee now only consumes 0.025% of AUM. This is where economies of scale actually provide a benefit.
I see. So while those fixed lump sum costs, their percentage impact goes down as the fund grows, the majority of the cost, that big management fee, it stays glued to the total assets.
Correct. And because that management fee usually just dwarfs the fixed dollar costs, the overall expense ratio tends to be pretty constant. That makes significant future reductions very unlikely for historical funds. If you buy a fund with a 1.5% ER today, you are essentially signing up for a permanent 1.5% headwind against your returns for the lifetime of that investment.
Now, let's pivot to a fascinating implication of this cost structure. The expense ratio's damage isn't linear. It's disproportionately devastating depending on the type of investment you choose.
And here's where the math really moves from just accounting into investment strategy. We need to look at the ER relative to the expected gross returns of the asset class. So let's use 3 categories with dramatically different expected returns: equity funds, bond funds, and money market funds.
And we'll use a high fixed 1 per turn ER across the board just for this illustration, even though, real-world index funds are much cheaper. So starting with the highest return environment, equity funds.
Historically, let's assume an average gross return of 9% for a typical equity fund before you take out any fees. That 1% ER consumes approximately 11% of your return. That's 1 divided by 9.
It's a significant cut.
It is, but you still retain 89% of the gross return.
Okay, now we move to bond funds, a medium return environment.
Bond funds typically have lower historical gross returns, so let's say 8%. That same 1% ER now consumes about 12.5% of the investor's return, 1 divided by 8. The fee itself hasn't changed, but the relative drag is already higher because the denominator of the return is smaller.
And this effect becomes extreme when we look at those low-yield, short-term investments like money market funds.
This is where the expense ratio becomes truly devastating. Assuming a typical long-term historical gross return of only 5%, that 1% ER now consumes a substantial 20% of the historical total return. That's 1 divided by 5.
Wow. So in this simplified example, the same 1% fee is nearly twice as painful in a bond fund as it is in an equity fund, and then almost double again in a money market fund.
Exactly, and this analysis becomes even more critical when you factor in inflation. If you have a money market fund that's yielding 5% gross and a 1% ER, your net return is 4%. If inflation is 3%, your real return is only 1%.
So that 1% fee consumed a massive chunk of the profit, and a little bit of inflation ate up most of what was left.
That's right. The key takeaway here for you, the listener, is clear. You have to consider the ER relative to the expected returns of the asset class. In the current environment, where fixed income returns have often been compressed or even negative in real terms, a high ER is far more damaging to a low return investment than to a potentially high return, high volatility one.
Before we move on from fund analysis, we need to touch on a specific issue that can often cloak the true expense structure, particularly in funds that are just getting started, this concept of waivers and recoupments.
This is so essential for investors who are looking at newer funds. As we mentioned, new funds inherently have high expenses because their asset base is small, and those fixed lump sums, they hit hard. So to attract early investors, the fund advisors will often enter into what are called waivers or reimbursement agreements.
So the advisor is temporarily footing the bill to artificially push down the reported ER just to make the fund look competitive. What's the catch?
The catch is the recoupment plan. These waived or reimbursed amounts, the money the advisor essentially lent the fund, often have to be repaid by the fund later on. SEC rules generally allow funds up to 3 years from the date the expense was incurred to collect this money back.
So an investor buys a fund in year one because the ER is, say, 0.5% because of a waiver, but that 0.5% was artificially low. Then in year three, the fund performs well, and suddenly the management is allowed to claw back those waived expenses from the previous 2 years.
Precisely. The implication for future shareholders is that you may be required to absorb expenses that were incurred by the fund during prior years. It's like a hidden debt that subsequent investors are responsible for repaying.
It feels like an ethical gray area.
It is. The fiduciary incentive is to waive costs to attract assets, knowing that those costs can be recovered later from what will hopefully be a larger pool of shareholders.
So the lesson here is that you can never just look at the current ER of a new fund. You have to check the prospectus for any active recoupment plan, because that beautiful low ER might be hiding a future increase just waiting to be triggered.
That's the key.
We've seen the ER as a measure of investment leakage, but this concept of operational efficiency, how much money is consumed by the administrative engine, is essential in other sectors too. Let's look at how donors use a parallel metric in the world of nonprofits.
This is a direct conceptual translation. For charities and for donors, the primary focus is the program expense ratio. It's the percentage of a charity's total expenses that go directly into executing the charitable mission, the program services.
So if a charity spends $100 total, and $85 of that goes to, say, feeding the hungry, the program expense ratio is 85%.
Correct. Which leaves us with the remainder. The support service expense ratio, which is commonly, though often inaccurately, just called overhead. By definition, the program expense ratio plus the support service expense ratio, they have to equal 100%.
And the simple common rubric is that a higher program expense ratio, and thus lower overhead, signals greater efficiency, which makes the charity more attractive to donors.
That is the initial surface level assessment. But leading sources of information about charities, like Charity Navigator and GuideStar, they strongly caution against blindly pursuing the lowest possible overhead. This is really where critical thinking is required.
Why is optimizing for low overhead potentially a bad thing?
Well, it can lead to what's called the starvation cycle. If a charity focuses obsessively on keeping its overhead staff, salaries, technology, facilities, fundraising below, say, 10%, they might underpay critical staff, use outdated and inefficient technology, and they might fail to invest adequately in effective fundraising or proper impact evaluation.
So they look efficient on paper, but they're struggling to scale or maximize their long-term mission effectiveness.
Precisely. They might have a fantastic program expense ratio, but they're inefficient at their core mission delivery because they haven't invested in the proper infrastructure. High efficiency requires professional management, good systems, the ability to measure results, and those things cost money.
Donors need to look beyond that overhead percentage.
They do. They need to look at factors like transparency, governance, strong leadership, and verifiable long-term results.
Just to give our listener a frame of reference, what are typical overhead levels in the U.S. nonprofit sector?
Based on 2009 data from Charity Navigator, the national median for the support service expense ratio, the overhead, was 10%. But more importantly, the source noted that more than 3/4 of ranked charities had an expense ratio of less than 30%. If you see a charity with an overhead far exceeding 30-35%, that is usually a legitimate red flag that needs some scrutiny.
Okay, before we make our grand transition to the Sharpe ratio, let's quickly anchor this expense ratio concept back in general business operations.
Absolutely. Beyond funds and nonprofits, the expense ratio is a staple tool for finance and accounting professionals. In a business context, it just shows the percentage of an operation's gross revenues that is allocated to its running expenses.
It sounds a bit like gross margin, but more detailed on the operating side.
It's a measure of operational leakage and management effectiveness. Business managers use this index in their profit and loss statements to draft business plans, produce forecasts, and, determine opportunities for cost-cutting or revenue maximization.
So it's an early warning system.
It is. If a company's expense ratio is trending upward over a few quarters, it signals a structural problem. Either revenue is stalling or the operational costs are getting bloated relative to the scale of sales.
Okay, we've thoroughly nailed down the cost side, that predictable structural drag represented by the expense ratio. We know it's sticky, disproportionately affects low-yield assets, and it can be hidden through recoupment plans. Now let's pivot entirely to the reward-for-risk side and move into the Sharpe ratio.
Perfect. So if the expense ratio is the concrete cost you pay for the journey, the Sharpe ratio is the metric that tells you, mathematically, how efficiently the manager used risk to generate returns.
It's the measure that tries to differentiate skill from just sheer luck or from taking on way too much risk. What's its core function?
Its core function is to measure the performance of an investment, a security, or a portfolio compared to a risk-free asset. But critically, it adjusts for total risk. It quantifies the premium return you receive for every unit of volatility you take on.
And the measure itself is named after the Nobel laureate William F. Sharpe, who developed it back in 1966. What should our listener understand about its historical context?
Well, the initial version was called the reward-to-variability ratio, and it used a constant risk-free rate as the benchmark. But Sharpe himself revised the definition in 1994, which is really key historical detail.
And what made that revision necessary?
The original static risk-free rate, it just didn't account for changing market dynamics. If you were comparing two funds across a decade where interest rates were changing wildly, say the volatile 1970s and 80s, that static risk-free rate completely invalidated the comparison.
Because the opportunity cost of capital was always shifting.
Exactly. The 1994 revision replaced that constant risk-free rate with a more applicable and time-changing benchmark return, and that made the ratio far more robust for long-term comparative analysis.
Let's look at the modern formula, even if just conceptually, to really understand the relationship between the numerator, which is the reward, and the denominator, the risk.
We typically look at the ex-ante formula, the one using expected returns, but the concept holds for ex-post or realized returns as well. The numerator is the expected value of the excess return.
So that's the assets return minus the benchmark return, which is often a U.S. Treasury security.
Correct. It's measuring the premium, the return that exceeded what you could have gotten in a virtually risk-free vehicle. And importantly, that asset return is the net return. It's calculated after the expense ratio has been deducted.
And that's a crucial link back to part one.
It is. If your ER is high, it drags down that asset return and automatically reduces your excess return. That reduces your Sharpe ratio, regardless of the manager's skill.
So the expense ratio is guaranteed to impact the Sharpe ratio negatively. Now the denominator. This is the critical risk adjustment.
The denominator is the standard deviation of the asset's excess return. This is the key measure of risk, or volatility. Standard deviation measures the historical spread of returns around the average. By dividing the excess return by the standard deviation of that excess return, you quantify exactly how much bang for your risk buck you received.
So a higher Sharpe ratio means you got more premium return for the amount of volatility you had to endure.
That's it. When you're comparing two assets, if asset A has a Sharpe ratio of 1.0 and asset B has 0.5, you should prefer A because it generated twice the reward for the same unit of risk.
That's the textbook answer anyway.
It is, and the real-world evidence can be pretty compelling. The source provides the example of Berkshire Hathaway, which achieved a Sharpe ratio of 0.79 between 1976 and 2017. You compare that to the overall stock market, the S&P 500, which only managed 0.49 during that same period.
So that 0.79 number isn't just about getting high returns. It means that Warren Buffett generated those high returns while incurring significantly less year-to-year volatility than the market itself. That's really the definition of a high-quality return.
It demonstrates superior risk management. And before we move on, we should just briefly touch on the information ratio. While the Sharpe ratio uses the risk-free rate as the benchmark, the information ratio substitutes a typically risky index, like a specific sector index, for that benchmark.
So it's for measuring a manager against their specific mandate.
Exactly.
Now, Sharpe ratio stands on the shoulders of earlier thought. Let's look at the precursors, specifically Andrew D. Roy's ratio from back in 1952.
Roy's ratio was conceptually similar. It aimed to maximize a ratio, but the key philosophical difference was in the numerator. Roy used what he called the disaster level, or the minimum acceptable return, MAR, rather than the risk-free rate.
So he was focused on avoiding a specific level of loss.
Right. He was focused on the probability of a return falling below a specified acceptable threshold. And the denominator was also a bit different. He used the standard deviation of gross returns, whereas Sharpe's modern ratio uses the standard deviation of excess returns. It's a subtle but important shift in focus.
And this discussion about a minimum acceptable return, it immediately brings up the Sortino ratio, which is often cited as a superior measure in some contexts.
Well, the Sortino ratio is philosophically aligned with Roy's initial concept because it also uses that MAR in the numerator. But the key technical advantage of Sortino is in the denominator. It uses downside deviation.
Meaning it only penalizes volatility when returns fall below that minimum acceptable return.
Exactly. It ignores upside volatility, which most investors view as a good thing. Sharpe, on the other hand, penalizes all volatility equally, up or down.
That's a crucial distinction, and we'll come back to that in the outro. Finally, the necessary comparison, Sharpe versus the Trainer ratio.
The distinction is fundamental. It relates to the type of risk the manager is being measured on. The Sharpe ratio considers total risk, both systematic risk, which is market risk you can't diversify away, and idiosyncratic risk, which is asset-specific risk you can diversify away.
And the Trainer ratio.
The Trainer ratio considers only systematic risk. And this is because the Trainer formula divides the excess return by beta. And beta is inherently a measure of systematic risk, the asset sensitivity to the overall market movement.
So if I am building a portfolio with, say, 100 different stocks, my portfolio is already highly diversified. In that case, the idiosyncratic risk, the company-specific risk, has largely been filtered out.
Exactly. So if you, the investor, are looking at a manager running an already well-diversified portfolio that is just one component of your overall assets, Trainer is often the superior metric. It rewards the manager only for the market risk they must take. Sharpe is generally better for evaluating a single, undiversified asset or a strategy in isolation.
And since these measures rely so heavily on math, they need statistical validation.
That's right. There are statistical tests, like those proposed by Jobson and Corky and by Gibbons, Ross, and Schenken. They exist to determine the statistical significance of a high Sharpe ratio, helping investors figure out whether a manager's success is due to genuine, repeatable skill or just statistical luck over a short, favorable period.
This section is the Deep Dive's core warning label. The Sharpe ratio is a powerful tool, but it rests on a foundational assumption about the market that is, well, it's often violated.
It is. It assumes asset returns are normally distributed following that classic neat bell curve.
And the reality is that the market rarely, if ever, conforms to a perfect bell curve.
Precisely. Asset returns exhibit abnormalities. We see skewness, where the distribution is lopsided, maybe favoring modest positive returns, but having a long, thin tail on the catastrophic loss side. And we also see kurtosis, which means the distribution has higher peaks around the average and fatter tails than predicted by a standard bell curve.
Let's clarify fatter tails. What does that mean for an investor?
Fatter tails mean that extreme, rare events, both massive gains and huge losses, they occur more frequently than the mathematical model of the normal distribution would predict. The standard deviation, which is the denominator in the Sharpe ratio, it becomes an ineffective measure of risk when these abnormalities exist. It will tell you the average routine volatility is low, giving you a false sense of security.
The danger is that the standard deviation calculated on all that routine data fails to capture the true magnitude and probability of those rare catastrophic losses, the black swan events.
You've hit the nail on the head. If a strategy's returns are negatively skewed, meaning losses, when they occur, are huge and rare, the standard deviation calculated over a normal period will be deceptively low. That artificially inflates the Sharpe ratio and compromises its accuracy as a true predictor of downside risk.
This inherent vulnerability means the Sharpe ratio can be manipulated, or at least strategically exploited, by fund managers who are focused on optimizing the number rather than minimizing the actual risk. The examples here are deeply instructive.
The classic example is the Ponzi scheme. Before it collapses, a Ponzi scheme generates these stable, positive reported returns because the returns are just earlier investors' principal. Since the reported returns are so stable, the standard deviation is virtually zero.
Which gives it an incredibly high Sharpe ratio.
An unbelievably high empirical Sharpe ratio. The number looks fantastic, but it's masking a guaranteed 100% loss risk.
That shows the SR is only as good as the underlying data reflecting genuine market risk. What about legal strategies that similarly exploit this flaw?
A very common one is selling low-strike put options, or out-of-the-money options. This generates a small, consistent premium income, which keeps returns stable, positive, and volatility low. A manager can run this strategy for years and produce a superb Sharpe ratio. But this strategy carries a small probability of a catastrophic, ruinous loss if the market crashes and those puts are exercised.
So the SR measures the frequency and size of all the small winning moves, but it utterly fails to weigh the potential for that single, ruinous outlier event that defines the strategy's actual risk.
Precisely. Another vulnerability comes up with illiquid assets, where the SR is susceptible to manipulation through smoothing returns. If a fund can use discretionary pricing or internal valuation models for assets that don't trade daily, they can artificially smooth out the volatility. They suppress the standard deviation and inflate the SR.
So smoothing returns is essentially just taking the peaks and valleys out of the performance to make the volatility look lower than it truly is.
That's right. For assets with smoothing, like certain real estate funds or private equity vehicles, the reported fund returns are inherently misleading. The SR should ideally be derived from the performance of the underlying assets, the actual cash flow or market price changes, not just the reported fund returns.
And are there statistical tools available to detect managers who might be artificially smoothing volatility?
There are. Analysts look at statistics like the bias ratio and first-order autocorrelation. High autocorrelation, where the return in one period is highly correlated with the return in the next, is often a statistical red flag that returns are being artificially managed or smoothed, as true market movements are rarely that perfectly connected day to day.
And finally, there's the need for data length. If the ruinous events are rare, you need a commensurately long track record to capture them.
A reliable empirical SR estimate requires collecting data over a sufficient period to observe all aspects of the strategy. If a high-frequency trading algorithm makes thousands of trades daily, you might get a reliable SR in a month. But if a strategy is built around catastrophic insurance liabilities that only pay out once a decade, you need decades of data to truly understand the risk.
And even then, you might miss something.
You might. The source emphasizes that even long track records may still miss those rare, extreme risks if the strategy has a very long tail of potential loss.
Let's move to how the ratio behaves in scenarios where performance is just poor or the incentives are misaligned. What happens when the Sharpe ratio turns negative?
A negative Sharpe ratio means the portfolio underperformed its benchmark, likely because the excess return, the numerator, is negative. And when the ratio is negative, it becomes deeply counterintuitive.
Can you walk us through that specific mathematical oddity?
If the SR is negative and the manager were to suddenly increase the volatility, the denominator, which is a bad thing, the denominator gets larger. Because the ratio is negative, dividing by a larger positive number actually makes the resulting negative ratio numerically less negative.
And therefore technically higher.
Technically higher.
That is deeply confusing.
Yeah.
So increasing risk makes a bad number look technically better. If I see a manager reporting an SR of negative 0.5 and another reporting negative 0.1, I'm supposed to prefer the negative 0.1 even if the only way they got there was by increasing their risk.
This proves the SR is often useless in bear markets or for strategies that are underperforming the risk-free rate. Investor utility functions always prefer lower volatility, but the math of the negative SR rewards higher volatility. That's why many analysts only use the SR when the excess return is positive.
This fragility also contributes directly to the principal-agent problem. The investor, the principal, wants safety and sustainable returns, but the manager, the agent, might be incentivized to just chase a high number.
That's a textbook misalignment. Fund sponsors who select managers solely on who generates the highest SR can unintentionally incentivize those managers to adopt high SR, high-risk strategies, like that short option strategy we mentioned. Selling options generates consistent fees and modest positive payoffs, which leads to a great SR, which maximizes the manager's short-term bonus.
So the manager gets paid handsomely based on the high SR, but the investor holds the bag for that small probability of catastrophic loss.
Exactly. The source specifically notes that selling out of the money calls and puts is mathematically determined to maximize the SR in the short term, even though it exposes the fund to ruinous tail risk that most investors are trying to avoid. This perverse incentive structure is a fundamental failing of relying solely on the standard SR for manager selection.
And finally, we have to address that common, oversimplified rubric we see in financial media. The one that says an SR over 1 is acceptable, over 2 is very good, and over 3 is excellent. Why is this rubric fundamentally flawed?
It is flawed because a Sharpe ratio is a dimensional quantity. Its magnitude is highly sensitive to the time period over which the returns are measured. The comparison only works if the time frame is standardized, typically annualized.
Explain the math behind that scaling problem.
The numerator, the expected excess return, it scales linearly with time. If you double the time period, you double the expected return. However, the denominator, the standard deviation, scales with the square root of time.
So if I calculate a monthly Sharpe ratio of 0.3, and I incorrectly assume I can just multiply the entire ratio by 12 to annualize it, I'm going to get a really inflated number.
You are. The return portion scales by 12, but the risk portion only scales by the square root of 12, which is about 3.46. You're understating the annualized risk relative to the annualized return, and that inflates the final ratio. The accepted method requires you to first annualize the return and the standard deviation separately, using the right scaling factors, and then calculate the ratio.
So those targets of 2.0 or 3.0 are pretty unrealistic.
For most diversified asset classes, they're utterly unrealistic. Most diversified indexes have annualized Sharpe ratios below 1.
Given all these inherent weaknesses, analysts have developed several advanced methods either to correct the SR or provide alternatives. What are the major corrections being used today?
For practitioners, especially those dealing with shorter track records and potential data issues, the deflated Sharpe ratio is critical. This ratio is proposed specifically for hedge funds with short track records, and it aims to correct for asymmetry, fat tails, sample length, and the selection bias that tends to make reported SRs look overly optimistic.
So it's a stress-tested Sharpe ratio.
That's a good way to put it. It's an SR that has been rigorously stress-tested for all these known flaws.
What about the application side? How can the SR be converted into an actionable metric for sizing investments?
That's where the Kelly criterion comes in. While the SR is a risk-adjusted ratio, the Kelly criterion can be used to convert it into a suggested rate of return based on optimal sizing. It calculates the ideal size of an investment, which, when you adjust it by the period and expected rate of return per unit, gives you a prescriptive rate of return. It moves the metric from just comparative performance to optimal capital allocation.
And finally, let's revisit portfolio construction. We established that idiosyncratic risk can be diversified away. Is there a scenario where you would intentionally hire a manager with a low or even a negative Sharpe ratio?
Absolutely, and this is illustrated by the proposed Sharpe ratio indifference curve. This concept demonstrates that it can be highly efficient to hire managers with low or even negative individual Sharpe ratios, provided their correlation to your overall portfolio is sufficiently low.
Because they zigzag when everyone else is moving in the same direction.
Yes, their poor individual SR is offset by the tremendous diversification benefit they provide to the whole portfolio. They act as an insurance policy, potentially benefiting the overall portfolio Sharpe ratio, even if their individual number looks terrible. It illustrates that good portfolio construction requires looking beyond the single SR number of any one component.
So what does this all mean for you, the learner? We started with the expense ratio, that predictable, guaranteed cost that quietly consumes your net returns, sometimes disproportionately, especially in those low-yield vehicles. And we highlighted the need to watch out for recoupment plans that hide future ER increases.
Then we tackled the Sharpe ratio, a powerful but fundamentally tricky metric that's trying to quantify the quality of the return relative to the total risk taken. We uncovered that a high SR doesn't guarantee safety, as it can be the result of ignoring fat tail risks, smoothing returns, or adopting strategies that are optimized for high short-term returns but carry catastrophic long-term risks.
And what's fascinating here is the interplay between them. The expense ratio, which is concrete and predictable, directly impacts the asset return in the Sharpe ratio numerator. It is the structural cost.
And if your costs are excessively high, no matter how clever your manager is at risk selection, that cost will suppress your net return, reducing your excess return and, well, resulting in a lower Sharpe ratio. They are inextricably linked. The ER determines the certain cost, and SR measures the efficiency of the return generated after that cost is paid.
The key is knowing where the metrics are vulnerable. Never trust the number without understanding the time period used for the calculation and the assumptions about return normality. For managers who are paid based on optimizing a number, you must always verify the type of risk they're actually running.
Which raises an important final question. Given the known vulnerabilities of the Sharpe ratio to non-normal distributions and its failure to distinguish between upside and downside volatility, how might a reliance on metrics that specifically penalize only downside risk, like the Sortino ratio or the omega ratio, fundamentally change the investment strategies managers choose to implement and the types of assets they buy? That's something to mull over as you analyze your next financial statement.